In part 1, we talked about what you should understand before investing your first $100 in Canada, emergency fund, high-interest debt, risk, time, and why investing is not a get-rich-quick machine. Now let's move to part 2. How could a beginner actually start investing their first $100? And this time, let's make it more interesting. We'll bring in numbers, charts, examples, and some TSX-listed ETFs that Canadian beginners often search for. Important reminder, any ETF mentioned in this video is for education only, not a recommendation to buy. Welcome to Investing with Pankaj, where we make personal finance and investing simple for beginners. Today, let's talk about how to invest your first $100 in Canada. But before we begin, remember this: the goal of your first $100 is not to become rich overnight. The goal is to start learning. Because once you understand how to manage $100, you are building the skill to manage $1,000, then $10,000, then more. Think of investing like going to the gym. You do not walk in on day one and lift the heaviest weight in the building, unless you want your back to resign immediately. You start small, learn the movement, build confidence, and slowly get stronger. Investing is similar. Your first $100 is not about showing off. It is about learning the process, how accounts work, how ETFs work, what risk feels like, and what happens when markets go up or down. Now let's talk numbers. Imagine you invest $100 one time and leave it alone for 30 years. If it grows at an average of 5% per year, that $100 could become about $432. At 7% per year, it could become about $761. At 9% per year, it could become about $1,327. These returns are not guaranteed, but this example shows why time matters. Investing $100 once is a good start, but investing consistently can be even more powerful. Imagine investing every month for 30 years. At a 7% example return, $25 per month could grow to roughly $30,000. $50 per month could grow to roughly $61,000. $100 per month could grow to roughly $122,000. Your actual results will depend on market returns, fees, taxes, timing, and what you invest in. But the lesson is simple: the habit matters. Readiness check. Before investing, ask yourself 3 questions. Do I have some emergency money set aside? Do I have high-interest debt, like credit card debt? Can I leave this money invested for the long term? If the answer is no, that does not mean you failed. It simply means investing may not be your first step yet. Your first step may be building an emergency fund or paying down expensive debt. Investing while carrying high-interest debt can be like trying to fill a bucket with a hole at the bottom. Next, understand where your investment will live. In Canada, beginners often hear about accounts like TFSA, RRSP, FHSA, and non-registered accounts. These sound complicated, but let's keep it simple. An investment account is like a container. What you buy inside the container is the investment. The account is not the investment. It holds the investment. So when someone says, "I invested in my TFSA," the next question should be, what did you invest in inside the TFSA? For many Canadian beginners, a TFSA is often one account they hear about first. TFSA stands for Tax-Free Savings Account. But despite the name, a TFSA is not just for savings. Depending on your provider and account type, a TFSA can hold qualified investments like cash, GICs, stocks, bonds, mutual funds, and ETFs. Think of it like a pizza box. The box is the account. The pizza is the investment. And the toppings are what is inside that investment. Finance becomes easier when pizza is involved. Now let's talk about ETFs. ETF stands for Exchange Traded Fund. That sounds complicated, but in simple words, an ETF is a fund that can hold a collection of investments inside it. Some ETFs hold stocks. Some hold bonds. Some hold both. Some focus on Canada. Some focus on the US. Some are global. Some focus on sectors like gold, technology, banks, or energy. So do not hear the word ETF and think every ETF is automatically safe. You still need to understand what is inside it. Let's use pizza again. Buying one stock can be like buying one topping, only pepperoni. If pepperoni does well, great. If pepperoni disappoints, your whole pizza suffers. Buying a broad ETF can be like buying a pizza with many toppings: pepperoni, mushrooms, peppers, olives, onions, and cheese. You are not depending on just one topping. That mix is called diversification. Diversification can help spread risk, but it does not remove all risk. The pizza can still get cold. The market can still go down. That is investing. Now let's look at some TSX-listed ETF examples that Canadian beginners often search for. Very important, these are examples only, not recommendations. I am not saying you should buy these. I am using them to explain how different ETFs can have different goals. Your choice depends on your risk tolerance, timeline, account type, fees, goals, and personal situation. The better question is not, which ETF is the best? The better question is, what does this ETF hold, and does it match my goal? Example 1, VFV. VFV is the Vanguard S&P 500 Index ETF. It seeks to track the performance of the S&P 500 index before fees and expenses. In simple words, VFV gives Canadian investors exposure to large U.S. companies. Think of it like a U.S. large company pizza. It can include many big American companies across different sectors. But remember, VFV is still an equity ETF. If the U.S. stock market goes down, VFV can go down too. Broad exposure does not mean risk-free. Example 2, XIC. XIC is the iShares Core S&P/TSX Capped Composite Index ETF. In simple words, XIC gives exposure to the broad Canadian stock market. Think Canadian banks, energy companies, railways, telecom, materials, and other major Canadian companies. This is like the Canadian market pizza. It can help someone understand what broad Canadian market exposure looks like. But it still moves with the Canadian stock market. So if the Canadian market struggles, XIC can struggle too. Example 3, VDY. VDY is the Vanguard FTSE Canadian High Dividend Yield Index ETF. In simple words, VDY focuses on Canadian companies with higher dividend yields. Beginners often hear the word dividend and think, nice, money coming in. And yes, dividends can be attractive. But dividends are not free magic money. Companies can change dividends. ETF prices can still go down. Dividend-focused ETFs can also be concentrated in certain sectors. So VDY is useful as an example of dividend-focused investing, but dividend-focused does not mean guaranteed safety. Example 4, XGD. XGD is the iShares S&P/TSX Global Gold Index ETF. In simple words, XGD gives exposure to global companies that produce gold and related products. But here is the important part, this is not the same as holding a physical gold bar in your hand. XGD gives exposure to gold-related companies. Those companies can be affected by gold prices, mining costs, company decisions, market sentiment, and many other factors. So XGD can be volatile. Think of it like a spicy gold pizza, interesting, shiny, but not automatically safe. Example 5, XEQT. XEQT is the iShares Core Equity ETF portfolio. It is an all-in-one equity ETF portfolio. In simple words, it gives exposure to stocks across different regions in one ETF portfolio. This helps explain the idea of one-ticket investing. Instead of buying separate ETFs for Canada, the US, international markets, and emerging markets, an all-in-one ETF portfolio can combine broad exposure into one fund. But XEQT targets 100% equity. That means it can go up and down a lot. Simple does not mean risk-free. So let's compare these examples simply. VFV gives exposure to large US companies through the S&P 500. XIC gives exposure to the broad Canadian stock market. VDY focuses on Canadian high-dividend stocks. XGD focuses on global gold-related companies. XEQT gives all-in-one global equity exposure. Different ETFs, different ingredients, different risks, and different purposes. This is why beginners should not just ask, what ETF should I buy? A better question is, what does this ETF do, and does it match my goal? Now let's make the ETF examples even simpler. Imagine a risk spectrum. On one side, you have broad market ETFs. On the other side, you have more concentrated sector ETFs. VFV gives exposure to the US large company market. XIC gives exposure to the broad Canadian market. XEQT gives global equity exposure in one fund. VDY focuses more on Canadian dividend-paying companies. XGD focuses on gold-related companies. The narrower the focus, the more important it is to understand the risk. A mixed-topping pizza is different from a pizza with only jalapenos. Now let's talk about fees. Many ETFs charge something called an MER. MER stands for Management Expense Ratio. In simple words, it is the ongoing cost of running the fund. You do not usually get a bill in the mail saying, "Hello, please pay your ETF fee." The fee is usually built into the fund's returns. Fees may look tiny, but over long periods, fees matter. A small difference in fees can add up over many years, kind of like one small subscription quietly becoming 5 subscriptions. Next, choose your approach. There are 2 common beginner paths. Path 1 is DIY investing. That means you open a self-directed investment account and choose the investments yourself. This can give you more control and maybe lower cost, but you are responsible for understanding what you are buying. Path 2 is using a robo-advisor or managed investing service. This can be simpler for beginners because the platform usually asks about your goals, timeline, and risk comfort, then builds and manages a portfolio. But it usually comes with an extra fee. Beginner investors often make one big mistake: they chase hype. They see a chart going up and think, if I do not buy now, I will miss everything. That feeling is called FOMO, fear of missing out. In investing, FOMO can turn a normal person into Risky Ron. Risky Ron sees one chart going up and says, "This is definitely going to the moon." Risky Ron has done no research. Risky Ron just likes rockets. Do not be Risky Ron. For beginners, boring can be beautiful. Next, know your timeline. Money you need next month should not be invested the same way as money you do not need for 10 or 20 years. If the money is for rent, bills, or emergencies, keep it safe and accessible. If the money is for long-term goals, investing may make more sense. Your timeline matters because investments go up and down. If you need money soon and the market drops, you may be forced to sell at a bad time. Investing usually works best when your money has time. So let's put it all together. If you want to invest your first $100 in Canada, here is the beginner roadmap. First, make sure you are not ignoring emergencies or high-interest debt. Second, understand which account you are using. Third, decide whether you want a DIY approach or more automated help. Fourth, learn what you are investing in. Fifth, understand ETF examples before buying anything. Sixth, compare fees. Seventh, think long-term. And eighth, avoid chasing hype. The first $100 is not about becoming rich tomorrow. The first $100 is about becoming the kind of person who understands money better. When you learn how to manage $100, you are building the skill to manage 1,000, then 10,000, then more. Start small. Stay consistent. Keep learning. And give your money time. Thanks for watching Investing with Pankaj. Follow or subscribe for simple investing and personal finance lessons for Canadian beginners. Educational only.